I'm Charlotte McLeod with the Investing News Network, and here today with me is Alain Corbani, Head of Mining at Finance SA and Manager of the Global Gold and Precious Fund. Thank you so much for joining me today. It's always great to see you online.
Good morning, Charlotte. It's always a pleasure to be participating in your show.
Yes, really nice to be catching up with you. And it's been a while since we last spoke. I think it was about a year ago that we were talking together the last time. So I want to start off with a quick look back at 2022. When it comes to gold, if you think about how it's performed in the last 12 months, has it been a surprise to you what the price has done?
It hasn't been a surprise at all. And against all the sentiment that is very negative around us, gold did behave pretty well. I know it could shock your audience, but because the mood is not there, but gold did perform well in if you quote it in the euro, if you quote it in the British pound. The gold has been performing positively. Everybody's focusing on the price of gold in US dollars, and this is depressing. But relative to other assets, gold did play a very defensive role, and rightfully so.
Okay, so we have a lot to go through today. And before we got started, you were mentioning a few points that you wanted to make. And I think one of the key things that we should start with is the direction of the US dollar, rates, and inflation. So you told me all these three things are going down. I wondered if we could work through those systematically and hear why you think that's the case, because I don't know that everybody else necessarily sees the same thing coming in 2023. So let's get started with that.
Nobody sees it coming in 2023, or at least not the consensus, but it has been going in our direction since the summer of 2022. So we're not speculating on future direction of the US dollar or inflation or rates. They are already in motion, and they are already declining. So I remind you what we said the summer of 2022, and we were very lonely when we said it. We said that we had reached peak inflation. We said that we had reached peak rates, and we said that we had reached a peak in the US dollar. In the meantime, what happened? Inflation has peaked. I repeat, inflation has peaked. If you look at the US break-even point, whether it's over a maturity of 2 years, over a maturity of 5 years or 10 years, the break-even are down from their peak of the summer or of September 2022. So that on that front, rates are going down. And when the Federal Reserve, the central bank, kept talking about maintaining a tightening policy, well, rates did go down. So keep that in mind. Actually, if you look at the 10-year rate, it peaked in, it didn't peak. It was in June at 3.50, 3.5%. It went up in the meantime to 4%. So yes, in that time frame, we were against the tie, but then rates went down back to 3.50, 3.40 today. So rates are going down. At least they haven't gone up since the summer of 2022. That's number one. On the inflation front, the break-even, the 10-year break-even point moved from 3% in March of 2022, and we're down to 2.3% today. So the expectations, the market is telling us that it does not expect inflation to go higher. It expects inflation to go down. And I just remind everybody that Everybody's talking about the PCE. Maybe that's the favorite measure of the Fed, but the reality, and this is very important, is that the break even of the 2-year, the 5-year, and 10 years are all circling around 2.3, 2.4, 2.5%. And again, I would like to remind the audience that it wasn't long ago, less than a year ago, that a lot of regional central banks were talking about, hey, by the way, maybe our 2% long-term inflation target is not that valid anymore, and maybe we should accept 2.5% and maybe 3%. Well, the market is telling you that 2-year down the road, 5 and 10-year down the road, we're already at these levels. So peak inflation is here, and I will give you other elements that will help you maybe be a little more convinced of what I'm saying, besides what the rates in the market, forward rates, are telling us. And the peak US dollar, the DXY, which is the measure that the basket against the US dollar. Well, in September it was at 114, 114, and today we're at 105. So September, November, December, the US dollar has edged down. So, and it's totally normal. If the market is telling you that inflation is decelerating, if the market is telling you with the forward rates that they don't expect inflation to accelerate, it's normal to have a US currency to depreciate. And we all know, and this is again good to remind everybody, that the only tool, the only efficient tool to trigger growth is a weaker currency. So the US at some point will make sure that the US dollar will weaken in order to defend, well, in the name of growth. And today we do have very conflicting measures telling us where growth is heading. But if you look at the favorite measures of the Fed, they themselves agree on the fact that we're going to have a slower growth in 2023 and an even slower growth in 2024. I'm not even mentioning the 2 negative GDP quarters of the first 2 quarters of 2022, and the fact that the forecast for the 4th quarter of 2022 by the Federal Reserve of Atlanta. There are a lot of numbers here, but remember that we're still evolving around 3% GDP growth. So there is no immediate urgency for the central bank to operate a pivot, or for the central bank to allow the currency to weaken. But the reality is that with lower rates, with lower inflation, the US dollar will weaken. That will be the only tool for the Americans to maintain some growth. One final point, if you allow me, Charlotte. In the 18 months, in the last 18 months prior to a presidential election in the US, in America, never have we seen rates go up. So this should give you some level of comfort that nobody who wants to be reelected wants to play with interest rates and risk to provoke a recession. So everybody's talking about inverted yield curve, about that the recession is knocking at our door in 23 or 24, maybe. But I just remind you that the first 2 quarters of 2022 saw a negative growth. So we don't need to have a strong recession, a hard landing. All we need is to have a growth that is decelerating, and that would be enough for the US currency and for rates and for inflation to continue decelerating.
Okay, I think that was a great summary of your thoughts. Thanks for going through all of that with us. I wondered if we could dig a little deeper into what's going to happen economically? Because I think, as you said, everybody's looking to see what happens here in the US. Do we get that soft landing? Do we get a hard landing? Do we get a recession? Do we get stagflation? Can you
Yes.
tell us a little bit more of your thoughts on that note?
I was telling you that inflation has peaked, and let me give you some data that support our. Besides the fact that forward rates are giving us this indication, rents are going down. So keep that in, and rent is a big portion of the core PCE. So rents are going down, and this will show later down the road in the inflation statistics. The labor market is weakening. You know, we keep focusing on monthly numbers of new job creations, and oh, by the way, it's stronger than what we expected. But the reality is that job openings, the creation of new jobs month after month, is decelerating. I'm not mentioning the fact that all the FANG have frozen the hiring, but the reality is that we do create fewer and fewer jobs in the US. So that's another consideration. The PMI, the ISM PMI number is sub 50. When an ISM, a manufacturing PMI, is under 50, it means that the economy is weakening. It means that it doesn't send a positive message for the growth. And finally, again, to support our reasoning, there's a huge discrepancy between the payroll survey and the household survey. And if you look at these numbers and you compare these two numbers, and we do favor the household survey over the payroll survey, well, we realize that there is a huge discrepancy. The payroll survey is showing additions of jobs, and the household survey is showing a loss actually of 500,000 jobs over the last 2 months. So that's there are enough information that are telling us the economy is weakening, and this is normal. When the central bank is tightening, it doesn't provoke more growth. The whole objective of the Fed tightening is to put an end to the pressure on prices, and also therefore on consumption, and therefore on growth. And this is exactly what the central banks all over the world are trying to do, and the Federal Reserve first and foremost. So slower growth, slower, are we going to have a recession? Yes or no? I have no idea, but I don't think that we're going to have a hard landing. Again, I remind you, the last 18 months prior to an election, there are no increase in rates. And I don't expect this to be any different this time heading into the 2024 presidential elections. So slower growth, slower inflation, yes, slower inflation, even though the PCE, core PCE is stubborn, but we are heading in that direction. And this should help rates to go down, inflation to go down, and the US currency to go down, and this will help gold go up.
Yes, I think that's the point that our audience probably most wants to hear a bit more about. So let's talk about gold in this environment, because what you are projecting for 2023 with lower rates, lower inflation, lower US dollar is essentially, I think, the opposite of what we've seen this year. So what does that look like for the gold price?
Well, if our scenario continues, I'm not saying if our scenario plays out in the future, if it continues playing out, because these, again, we have hit those peaks earlier, the previous months. Well, gold should continue to perform. So I remind again the audience that gold has performed relatively well versus other asset classes, and so it did play a role to be on the defense. But the gold miners did not, and all I think what your audience is focused on is the gold miners. You know, they are in negative territory, and I understand it, and it's in negative territory because gold in US dollar is in negative territory. But again, the inflation has hurt the margins of those gold miners, and since inflation has peaked, we do believe that those margins with a higher gold price will trigger a huge rebound in the gold space. Huge rebound. The same way we had this rebound in 2015, the same way we had this rebound in 2018, we are heading towards an identical rebound. And that rebound actually started, believe it or not, the rebound did start from the lows of a month ago.
Okay, so as we mentioned at the start of this conversation, you manage the Global Gold and Precious Fund. I wondered if you could talk to me a little bit about the fund and its composition in terms of size of company, jurisdiction, the type of thing that you're looking for in the companies you include there, and also how your approach may have changed during this time of what's going on in the gold space.
So we are lucky enough in this fund to have a very large mandate, and this mandate allows us to invest in all types of mining companies, whether it's large producers, whether it's intermediary producers, small producers, developers, explorers, whether we're talking about mining companies operating in the gold space or in the silver space or in the platinum palladium space. So that's we do invest in all these areas. That's number one. However, and what we have done is we have given more allocation to the silver names. Why? Because we think this is where there is more leverage, because this is where we've had a lot of damage done, but not damage to the balance sheet, damage in terms of pricing. So, and we focus on value. We are really stock pickers, investing in first looking at depressed levels, looking at quality for the assets and management, of course, but also for leverage now, because we think that this is the time to be aggressive. So we have increased the pocket dedicated to silver names. At the same time, what did we do? We covered our exposure to the US dollar, because we have been saying for the last 6 months that the US currency is meant to weaken. So we applied this rule, and today 100% of the allocation to the US currency is hedged in the portfolio. So we have quality names, we have more leverage than we used to have in the past through silver names, and we have covered our US dollar exposure.
Okay, I think that makes a lot of sense. So you mentioned for the miners, inflation has been a problem for them this past year. That's been difficult.
Yes.
In your mind, this is now fading away. But I want to ask about other challenges that the miners are facing. Is that the main one? Is inflation the main one? Or are there other things right now that you would point out that they need to address?
Well, yes. Yes and no. And this is the wrong answer I'm going to give you, because I don't believe in the problem, the hurdle they are facing, because it's more it's not based on facts. And let me explain. Inflation has with a stable gold price, let's make it simple. With a stable gold price, the margins of those miners did contract, rightfully so, because we had some inflation. So to penalize those companies in terms of pricing, this is absolutely logical and normal. What is abnormal is to penalize them because they don't fit into this ESG category. And actually, a very good friend of mine said a while ago, gold miners do not force children to work in their mines. Miners force children to go to school, and this is really the reality. Gold miners have done for decades a fantastic job on the S part and the G part. And everybody has tendency to forget these S and G and only focus on the E, the environmental equation. And this is wrong. This is wrong because this is not the reality. So you have this negative perception about miners who are polluting, but the reality is that maybe they are polluting. Yes, they are polluting because they are operating mines, right? They are drilling, they are extracting, but they are making huge efforts on this in this direction to improve their emissions of carbon dioxide. But at the same time, let's not forget how great examples they have been over the last 2 decades, because permitting takes forever. And to obtain your permit, you really need to show a real convinced and show proof that you are operating in a friendly and for a friendly environment. So I just ended a lunch today with institutional investors, and again I heard that the same topic. Miners are polluting; they cannot be. We cannot invest in them. But this is wrong, because what they are doing is way beyond just polluting, and they are polluting less and less. So we need to accept it, and we need to stop fantasizing on those miners who are exploiting poor and young people, because that's not a reality. It's fantasy. It's pure fantasy. So this is what we have to fight, and this is a fight that is hard to win when the initial statements are wrong. So this is a big challenge for the sector on the institutional front, not on the retail front, on the institutional front.
Okay, yeah, no, for ESG, I think that, you could have a whole conversation just around ESG. And I think you're right when you mention that the E gets forgotten. Part of the issue is that the ways of measuring it I don't think we really know how to do that yet. So it can be very confusing for investors. So really,
and
then,
and Charlotte, there is no norm. There is no norm.
Exactly.
So, and affabulations. So I don't know any publicly listed mining company. I don't know any publicly listed mining companies that is employing children. I don't. But this is the general perception. So it takes a lot of time. Or I think that people are starting to understand a little bit what we are saying, because ESG is starting to show its limits, but we're not there yet. So inflation was an issue in terms of reducing margins, affecting margins, and ESG is another issue that needs to be fought, addressed, and a lot of explanation to do.
And to recap, the challenge there is to basically have institutions understand what's going on there, because the retail investors get it. Institutions are wary of the sector. They don't necessarily want to get in because of the ESG constraints.
Exactly.
Okay. So that's really interesting. I think that's a topic everybody should really be following along carefully. So when we talk about institutions and retail investors, another thing that we were speaking about before we came online here was demand for gold. So you mentioned to me something very interesting, which is that the physical demand is strong right now. ETF demand, not so strong. So I wondered if you could talk about that for us, and when you see that flip switching in terms of ETF demand and what that could mean for the gold market?
This is really the core of the subject, actually, because you could be fundamentally right, but as long as there is no speculative interest, and I really emphasize the word speculative interest, because investment demand for gold triggers, affects the price of gold literally because of its speculative demand, the component of the speculative demand, nothing's going to happen. So jewelry is going up. China is buying more gold after the COVID years. India is buying more after the COVID years. So everything is back in order, I feel like saying, on that front. And that's more than 60% of the total demand, right? Central banks are buying gold. The industrial component doesn't count, it's less than 10% of the total demand. The only real aggregate that will change the momentum is investment demand, which is the speculative part of the total component of global demand. So, and we don't see it here. It's totally absent. So investment demand is totally absent. And why is it absent? We go back to our initial macro themes, because the market, our investors doubt that inflation has peaked, because investors doubt that rates have peaked, because the Fed is still in its tightening mode, and because the US dollar is strong. So as long as you are not going to have this component of the total demand start building up, most probably you won't have a move in the price of gold. So all it takes is for this investment demand to start showing some sign of life. And as long as we don't have it, gold will evolve in a neutral, boring mode. So we need that investment demand. Today it's absent, and when it comes back, this is when you get your real rebound in the price of gold or silver or other metals.
Okay, and the very tricky question, do we know when that might happen or what might trigger that to happen?
All we need is a continuity in those trends that we talked about earlier, the macro trends. If we continue seeing signs of deceleration in inflation, if we continue seeing signs that a weaker growth will definitely mean lower rates, and if the US dollar starts or continues weakening from its peak at 114, DXY at 114, we're at 105 today, well, this is when investment demand. So I think it's really a question of time. The movement has started, the trend is in place, but it's just, you have to be patient. All I think is a question of patience, and it's not a question of years, it's a question of months at best.
Okay, so I think you've really taken us in a full circle today with your thesis for basically for 2023. Before we wrap up, I wonder, what is your best advice for investors in the coming year?
Investors in the precious metals space or in
the
general?
Precious metals. Let's talk precious metals.
I think that in terms of valuations, the miners are very, very, very cheap. We're back to the levels of 2015 and 2018. So this is already one key element that should help them be comfortable holding their position in the gold miners. That's number one. Number two, if you look at some ratios of gold mines versus the Wilshire 5000, the total economy basically of the United States of America. If you look at the gold miners versus the price of gold, you again reach extreme levels, oversold levels for the miners. And this is telling you again that history is telling you that those oversold levels don't stay oversold very long. So we have more than actually, we haven't seen this space be so attractive, since the 4 years, in the last 4 years, we are really at oversold levels. And this means to me, for somebody who has been in the business for 30 years, this means to me that the rebound is really imminent.
Okay, well, that leaves me feeling, I think, a little bit more optimistic about next year. So thank you for going through everything with us today. That was really great.
Thank you very much, Charlotte.
Once again, I'm Charlotte McLeod with the Investing News Network, and this is Alain Corbani with Finance SA.